course, Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. If you like boring, if you like things that are uneventful and don't change a whole lot, you have arrived at the wrong year in 2022, because this year has experienced volatility unlike any year that we've seen in the mortgage industry, really in the past 50 years. As a matter of fact, the pace at which interest rates have risen over the first 10 months of 2022 is like nothing that we've seen in half a century. So you have to go back 50 years to find a year as volatile as the one that we've been in. And I'm going to show you a little bit about that and then talk to you about why a little bit of glimmer of hope has shown up this afternoon in the market. So let me flip the screen around and show you what I'm talking about. Here's the past, since the beginning of October, been on this really steady sell-off in mortgage-backed securities, very few bright spots. Here today, we're gaining back what we lost yesterday. I'll talk about that here in a minute. But if you go to a year-to-date look back, you can see all of this volatility up and down, up and down, up and down, most of it down in the wrong direction.
What? You're going the wrong way!
As interest rates head higher when these mortgage-backed securities sell off. But if we go to more of a max look back, you can see how stable things were for so long. Back in 2020 and 2021, obviously everyone wishing we were back to those historic low interest rates, but this has just not been the year for that. Some of the headlines that you might be reading is that mortgage rates spiked to the highest level in 20 years. That is 100% accurate. We've not seen mortgage rates at this level, over 7%, in the past 20 years. We know what's been happening in the UK. While the Prime Minister there tenuring the shortest term ever in the UK, just 44 days since Liz Truss took the office.
Something missing here, don't you think? It's over.
She's resigned after some chaotic weeks, implemented a brand new economic policy designed to benefit really the wealthiest of the citizens there in the UK, and has since scrapped that policy, fired her finance minister, and then ultimately has resigned. We know that the Fed is set to raise the Fed funds rate by another 3/4 of a point come November the 2nd. So the Fed will meet in a regularly scheduled session on November the 1st, November the 2nd. The policy statement coming at 2 p.m. Eastern time on November the 2nd. It's widely expected that the Fed is going to raise the Fed funds rate yet again by 0.75%. That's a jumbo-sized rate hike, and really coming because the past couple of inflation reports that we've come out have beat expectations. That's the wrong way. We don't want to be beating expectations. We want to be coming in under expectations, but inflation remaining a persistent problem here in the United States. On top of that, we get jobless claims that are coming in under expectations, showing a really, really strong, robust labor market. That doesn't help the inflation picture, and so we fully anticipate that the Fed is yet again going to raise the Fed funds rate by 3/4 of a point. So why are we seeing a little bit of a rally this afternoon? Why are we improving here on Friday by a healthy clip? Let me zoom back in. Well, this is around some statements that were made earlier today about the potential.
So you're telling me there's a chance
For the Fed to pause on their Fed rate hikes after the November the 2nd meeting. And this is for the first time starting to see a little bit of dissent within the ranks of the Federal Reserve about what to do after November 2nd. So rest assured, November 2nd is set in stone. But now we're starting to see a couple of Fed members come out and say perhaps it's time for us to pause and take stock of what we've done, because these Fed rate hikes don't immediately impact the economy. It takes time for the economy to adjust to where the Fed has set the Fed funds rate. Obviously, there's some trickle down that has to occur there. So ultimately, just the very mention of the potential for the Fed to pause Fed rate hikes has caused the stock market to bounce. We've seen the stock market up 400 points, and it's caused the bond market to do the same. We've seen some significant improvement in mortgage-backed securities throughout the day, all centered around just the potential.
Everybody have a good week?
There's good reason for this, because candidly, what we normally expect out of financial markets is if it's a bad year for the stock market, it's a good year for the bond market, and vice versa. If it's a good year for the bond market, it usually means it's a bad year for the stock market. So we see investment dollars move between these two entities based upon how the year's going. Well, this is one of those unicorn years where it's bad news no matter where you look. As a matter of fact, take a look at this headline. It's the worst year for stock and bond investors simultaneously since 1969. So we haven't seen a year quite like this in many, many decades. You can go back and see that the S&P is down nearly 24% year to date. That's the stock market. And at the bond market here, the aggregate bond indexes has surrendered up to 16% down. And should both of these indexes finish the year in the red, it would be the first time that that's happened since 1969. I'd be remiss if I didn't mention one thing. Highland Mortgage is pleased to welcome Mickey Schilling as our new VP of National Production. Great to have Mickey on board, 20-year industry veteran. I don't know that there's a person in the industry that Mickey doesn't know, and we're incredibly proud and thrilled to have her on board with us. Welcome, Mickey. Great to have you at Highland. If I can be of any service to you over the weekend, please don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend, everybody.